Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Advanced Charting Techniques. And today is a viewer request. I was going through the YouTube comments on another video just recently, and somebody said, "Hey, Cameron, can you talk about the disparity index?" Absolutely, we can talk about that. As a matter of fact, I kind of anticipated somebody may be asking about that because it bears um, a very strong similarity to the rate of change indicator that we just discussed a few weeks ago. So yeah, we're going to be talking about how traders sometimes use the disparity index to trade short-term stock extremes. Very common application for that chart tool. We'll talk about how it's built, how it might be used to plan and place a trade, and then we're going to plan and place a trade with it. So a lot to cover. Before we can get to any of that, though, let me first of all say hello to everybody who's chatting in. Great to see all the familiar Friday names. Hello there, Chris B. and Ray, Michael, Alfie, Helen, Wiley, Scott, Sharon, everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you happen to be here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, enjoy that recording. It's a great way to watch these webcasts. But if you'd like to be here in the live stream audience, as I mentioned, this is a Friday webcast series. We kick things off promptly at 1 Eastern time. Love to have you here in the audience. Now, as a treat for my audience members, we have my very good friend Scott Thompson. He's hanging out in the chats. He's going to be addressing any questions that I can't get to just during the flow of the presentation. Scott and I have been working together for a couple of decades now, so Scott brings a ton of experience to this discussion. Thanks for having my back there, Scott. I also want to throw out an invitation to everybody listening to please follow your favorite Schwab presenters on social media. You can find me on X and on LinkedIn. Give me a follow on either or both platforms. So you can follow me on X, at Cameron May CS is my handle there, or LinkedIn. Just go to linkedin.com/in, and then /Cameron May CS will take you to my profile and you can give me a follow. But that's the best place to have a conversation with me in between the live streams. But let's get into this discussion. And as we do, of course, technical approaches to trading and investing, just like so many other approaches to trading and investing, carry risk. So bear this important information in mind. This material is intended for general informational and educational purposes only. This should not be considered an individualized recommendation or personalized investment advice. Schwab does not recommend the use of technical analysis as a sole means of investment or research, and investing involves risks, including the loss of principal. All right, so let's set the agenda for today's discussion. That viewer request came in. Hey, Cameron, can we talk about this thing called the disparity index? And as the name implies, sometimes that's used by short-term traders to identify what they see as short-term stock price extremes. And they may try to trade those extremes from extreme lows to extreme highs, for example, over a short period. So we're going to talk about how the disparity index is built. We're going to build a scan to look for stocks that are maybe presenting traditional setups for a disparity index trade. We're even going to be pairing that index with a trend confirmation technique, and then we're going to be planning and placing an example trade. So let's get into this discussion. First thing that we do each week, though, is we look at our existing positions and we look at the markets. So thank you, Alfie. Appreciate that. Sent a connection on LinkedIn. But let's go to the Thinkorswim desktop. This is the paper money trading software platform. You can see right up here, we're in the simulated trading environment. Here are two current positions, both doing quite well, both quite profitable. I think there may be action to be taken on both of these. Let's have a look at our McKesson position first. This is back when we were taking small positions. We were taking little tiny positions just as examples. Kind of wish this one was bigger because look at how it's doing. Yeah, let's go to the McKesson chart. This trade was taken on the zigzag high-low indicator. Got in on a bullish entry. I refer to this as a zig. Looking for a bearish exit signal. I might refer to that as a zag. We haven't seen that yet. You can see we got quite a bit of waffling around. A zag requires a relatively large move in the other direction. We haven't gotten that yet. This earnings announcement, obviously, though, went very well for McKesson shareholders. We are only paper money shareholders, unfortunately. But I got a strong move to the upside. And so while we're waiting on the signal from our indicator, do technical traders sometimes just get faster returns than they ever might have hoped for? Yeah, it sometimes happens. So what technical management techniques might be employed at that point? Well, one is if we're going to hold on to those shares for that exit signal, maybe it's time to move that stop up. So we had a stop down below previous lows. How about we nudge this up? I think there was a high right here of about 895. What if we move that stop up to 890? Let's just click and drag that up here. Get that as close to 890 as possible. There we go. That'll bring up an order confirmation screen. We got it pretty close. $890.13. We could edit this if we want to adjust the pennies there a little bit. I'm going to call that close enough. And let's just send that order off. So now what we're doing here is hopefully we've shifted from managing risk to maybe just managing reward at this point. Now, obviously, a big gap down could even surrender all the gains on this very quickly. A stop is not a guarantee of an execution at a specific price. But I think other than that, we're going to let that trade continue to work. We'll keep an eye out here, see if we get that zag. Now, if you weren't here to see the discussion of the zigzag high-low indicator, if you're intrigued by it, what you might want to do is, first of all, make sure that you're subscribed to our Trader Talks channel on YouTube. You can go down below the video right now and just click on the subscribe button. It only takes a second, doesn't cost anything, but this is where you can join the live streams like we're having right now. But you can also find playlists of concluded webcasts, and these are organized by series. So this is the Advanced Charting Techniques series. And if I scroll down through all these series thumbnails, just below the midway point, there's our Advanced Charting Techniques. I can click on View Full Playlist, and here I can just look for the key words. It's going to be a few weeks back, but it's going to be the zigzag high-low indicator discussion that we had right there. Hey, you're new here. Great to have you. You like the stuff so far? Great stuff, you say? Great. All right. Well, let's go back to our other position. This is our Walmart trade from last week. Now this one, we took a slightly undersized position because of the technical outlook of the markets, which actually turned out to be somewhat accurate. We've kind of peeled back on markets since then, but Walmart didn't peel back. Here's what happened with our Walmart trade. Here's the logic of the trade. Let's bring up Walmart. I'm going to load up the study set for the Walmart position. This was a bull flag with an attempted enhancement of the intraday timing of the entry using VWAP. So the technical reason for the entry was a bull flag. So we had a flagpole here, a pullback, an apparent break of that flagpole. So the length of the flagpole, we went from about 110 up to about 120. And so maybe our trader was looking for price to rise from about 115 up to 125. So that 125 is where we're thinking if we can get to that level or beyond, maybe we'll start to harvest some profits. On the other hand, if price started to fall back below the flag, we were going to take losses down at 115. Well, fortunately, in this case, it doesn't always work out this way, but we've moved up to our flag target, and we've actually extended well beyond that. So I want to do two things here with this to learn a couple of different lessons from this trade. Number one, let's say that we're a trader who has determined, hey, you know what? It's time to take profits. I've hit my target. I've even gone beyond that. But still in that effort on an intraday basis, if we're just trying to see what time of day might we take that exit, we might go back to that 1 minute chart and look at our VWAP position. And for a trader attempting to optimize their exit, they may look for chances where we're sitting right up near that 2 standard deviation from the VWAP line, right up here. So we might have taken an exit here or here, kind of pulled back from there. We're about maybe 1 standard deviation above VWAP. We might take profits. In any case, that's one view. That's sort of circling back, closing the loop on our discussion of VWAP. But let's also put ourselves in the shoes of another trader. Let's go back to our stock. We're going to switch our time frame back to that 1 year chart. And you think there might be any traders, if they wake up in the morning on a day like this, maybe they haven't been paying attention and they blasted beyond a target, hey, maybe let's see how far this ride takes us. What might we do if we choose to go that route? Well, the trader might decide we don't have a stop. Because I wanted to have that VWAP discussion. I didn't want these shares to just be sold if we happen to fall back down to 115. But how about we change our stop at this point? I'm actually going to impose a stop, a physical stop on this trade at this point. And I'm going to do that. Let's set it right there at our target. So if we happen to pull back and we sell at 125, well, that was the original plan anyway. But if we also happen to rise further, we're still participating in that move. Now, Zach is saying we could attach like a trail stop. That's another potential approach. I'm just going to do just a price stop. Okay, so let's do that. Let's go to our monitor tab. Here's our Walmart position. I'm going to right click on that and create a closing order with a stop. And let's just put that stop at 125 for now. And we'll talk about this again in future weeks if it hasn't been hit yet. Now, as I confirm and send this, I just have to give the reminder that even though we're putting in a trigger price of 125, it's not a guarantee that that's a price we'll ultimately sell for if it happens to fall down there and get triggered. It could be less than that. In any case, no commission on this trade. Can be on some types of trades, but I'll send that order off. And now we have a plan there. As we go back here, we can see we have a stop now waiting, but still participating in the upside. All right, so that's it for our current positions. Let's have a look at what's going on with the markets and just frame things for our would-be technical trader. And I need to switch up my drawing tools here. Each week, if this is your first time, and I've seen a couple of people say this is their first time here, it's fantastic. But each week we look at the S&P 500 through the lens of what we call the TVM, or the Trend Value Momentum Strategy Set. So let's bring that up. Sudas says, what trading platform are you using? So this is known as Thinkorswim, and it's software, trading software that can be downloaded free of charge from within your Schwab Online account. You just go log into your Schwab Online account, go to the Trade tab, and then in the drop-down menu, you'll actually see Thinkorswim. Click on that. You'll see a big blue button that'll introduce you to Thinkorswim, help you download it. Okay, and then you just log into the software using your Schwab credentials. But let's look at what's going on with the S&P 500 through our trend indicator. That's, in this case, it's a 100 and a 50 triangular moving average pair. Our value indicator is the RSI, and momentum we're measuring with MACD. All right, so what's going on with trend? Well, the 50 triangular moving average is still rising above the 100, and for those that use this approach, that might just be a bullish confirmation. I don't think that's a huge insight for anybody that's been keeping an eye on the major indices. The S&P has actually been very strong. It's been coming back. We looked at this last week and thought it might be pulling down for a little while, and it did. But maybe things are technically changing at this point. Now, one thing that's also interesting is that over the last several months, that 100 period triangular moving average has been a pretty good price support for this index. It's not a guarantee that's going to continue, but let's say that our would-be TVM, trend value momentum trader, looks at this and they say, well, the trend is intact and actually prices seem to be bouncing off an apparent price floor. That's a check for maybe bulls. Let's look down at what's going on with the value. For some traders, they use RSI to gauge whether short-term prices are relatively high or low within a given trend. And one thing that just happened since we last met, let me zoom in here. You'll see the color scheming on our RSI change to green as we slipped below 40. For some, in an upward trending market, getting down below 40 is relatively uncommon, and it might mean that prices have reached relatively short-term, hey, theme for today, extremes. So we've dipped down to maybe a value scenario and starting to rise again. So that might be another technical check for the bulls. Now, finally, what's going on with momentum? Maybe I shouldn't have zoomed out because This is kind of small down here. But a typical view of a MACD histogram when gauging momentum is to look for the bright red to transition to dark red. In other words, for that red histogram bar to get a little bit shorter. Conceptually, that might mean, in other words, for that red histogram bar to get a little bit shorter. Conceptually, that might mean the selling momentum is starting to fade, and there's starting to be a little bit of buying momentum coming into the S&P 500. So that could be a third final check for the bulls. This adds up for a typical TVM trader to be a pretty bullish condition. All of that said, though, doesn't guarantee that that's exactly what the S&P is going to do. But let's just say that our trader here thinks they have a pretty strong backdrop for a new bullish trade. So we're going to be doing a new bullish trade today. And we're going to be doing that trade using the disparity index. So I'm going to bring up an example stock. I'll show you at the end of the discussion how I found the stock. We'll build a scan, run it, and as long as things haven't moved a lot, this stock should appear with that scan. So let's bring up, what did I choose? AMD? Yep, here's AMD. And I want to, let's remove the TVM strategy set. So let's just remove all studies. And I want to add our disparity index. Now, let me throw out the question as I add this. I know I got a pretty experienced crew here. We got over 200 people watching. There's a lot of traders here with a lot of experience. Has anybody traded the disparity index? Or let me rephrase that. Are you at all familiar with the disparity index? I think it's a pretty good name for this index because it's looking for price disparities from quote unquote normal levels. But let me load up the disparity index as you answer that question. I'm going to hit add, and you'll notice right next to disparity index, there's one simple insight into how this index is constructed. It says 13. This actually just looks back over 13 days worth of data. That's 13 trading days, or about half of a calendar month. It's built on an assumption that in the short term, prices can reach short-term extreme highs and short-term extreme lows, typically in cycles lasting about a month. So you split that in half, you get about 13 days. All right, so I see a whole lot of no's. I don't see a single person saying, yes, I'm familiar with this. All right, well, let's explain how this is built. Let me click apply and click OK. And there's our index right down below. So we have the green disparity index line, and then we have a signal line, the zero line. There are some indicators that have very complicated algorithms that generate the indicator. Then there are others that are actually, in my view, pretty straightforward, pretty simple. Now, I think when something is simple, it's easy to get kind of dismissive of it. Let me just recruit a sentiment from mathematics. What phrase does a mathematician use when another mathematician comes up with a quote unquote a simple algorithm to explain a concept? They have a name for that. Instead of saying it's a simple equation, they say it's an elegant equation. Can we go with elegant for this one? All right, yeah, it's pretty basic. So here is the equation for building the disparity index. We take price and subtract a 13 exponential moving average. And then we divide that by the exponential moving average. Let's put in the 13 again. And we multiply that by 100. That's it. You like that, Scott? Simple equals elegant? Yeah. Yeah. So they actually see it as a sign of intelligence, not as a sign of, let's say, I don't know, mental laziness. Anyway, so here's our equation, but here, what it's actually doing, if we take a current price, let me maybe throw on the 13-period exponential moving average here. I'm going to go up to our little flask. Let's type in exponential. There's our exponential moving average. Let's add that. And let's adjust this to be just a 13. Click OK and click apply. So here's our 13-period exponential moving average. What we're doing here is we take the current price, so price right now is at 208.14. We subtract the 13-day exponential moving average, which is at this moment 226.67. So 208, 13, 14 minus 226.67 is going to give us a value about minus 12. Okay. Then we divide that by 226.65. Should we do it? Let's do it. I wasn't planning to actually do the numbers, but let's do it. 208.02 minus the exponential moving average of 226.60. It's moving a little bit. It's okay. The pennies aren't going to matter very much. So that gives us a negative value. My math wasn't very good. It wasn't 12. It was minus 18. Anyway, we take that value and then divide it by the 226.66. So let's divide this by 226.66. And that gives us a decimal value of 821.9. But we need to multiply that by 100. And it gives us a final value of minus 8.21. Now, forgive the pennies, but does that pretty closely approximate the actual value? There's a little bit of a lag between me explaining how this is calculated and how, the system is keeping up with actual numbers. So that's what we wind up with here, which is actually just showing us in percentage terms how far price is below the 13-period exponential moving average. That's all it's doing. So that's our little elegant equation there. When it's positive, it generates positive numbers. When it's negative, it generates negative numbers, and those will fluctuate around a value of 0. So as let's simple or elegant or however we want to refer to that, what is it actually identifying for the trader? Well, what the short-term trader looking for extremes may be looking to identify is large departures from the 13-period moving average. 13 days isn't very long. This is actually a highly sensitive moving average that will typically stick very close to price. You can see that as we're going up. You can see that as we're going down. But every once in a while, we'll get extreme departures where price is able to escape, possibly just temporarily, from that moving average. And it's those movements that can attract the attention of the short-term traders. That's something that's unusual. There's a disparity happening here, potentially a tradable disparity. So what some traders will look for is an unusual, let's throw up in air quotes, an unusually large disparity between exponential moving average and current price. Some might define that as being at least 5% up or down. Some might define that as being at least 7 or 10% up or down. In this case, if you look at AMD, there are a couple of prominent touch points here where we're solidly below 0, meaning price is solidly below our exponential moving average, and those might signal potential reversal points, like this one here, or this one here, or possibly what we have over the last 48 hours. Yeah, Chris B says, are these possibly mean reversion trades? Yep, that's really a sort of an underlying sentiment of a trader who is looking for these sorts of moves. A mean reversion trade just means that when a stock has moved really far from its average or sort of its normal state, maybe the stock will move back closer to where it normally is. In other words, if we define normal as this trend line and we get a long departure, a large departure from that, maybe there will be a reversion to the mean, meaning price moving closer to our definition of normal. Yep, that's the concept there. So there might be some flexibility from one security to the next for how the trader identifies what a large departure is, but there tend to be some common threads. It moves under 5%. I don't typically run into lots of traders who would see that as a significant move. So when we have small moves below the 13 EMA or small moves above, it may not be of consequence to someone looking for an extreme move. Maybe more like 7, possibly 10%. How far did this one get below? We got to a low value actually of 12.5. So this was a 12.5% departure of price below that EMA. Now, however one defines an extreme move, I have to throw out another caution for what these extreme moves might mean. Okay, and Eric says, how would you use the divergence that starts in October as a signal? Good question, Eric. We'll talk about entry signals and exit signals and trade management, that kind of thing. But let's say that we are a bullish trader. Are we probably looking for a stock that's already run up, or maybe looking for a stock that's come down to an extreme extent? Probably looking for the downward move. The difficulty with that is maybe it's just another extreme move in a series of extreme moves to the downside, and the stock is in full collapse mode. For those, some traders might want to avoid those kinds of stocks, and instead, they might be looking for an extreme move where the stock is otherwise still behaving relatively bullishly. Maybe it still has, through one mechanism or another, one technical confirmation or other, still a bullish trend. Well, I'm going to borrow the same confirmation that we use for our rate of change indicator for a trend confirmation for our disparity index. These are, believe me, if you want to see how similar these two things are, the disparity index and the rate of change, go back and watch my archive for the rate of change from just about 4 weeks ago. So let's see where that was. So again, if you want to see exactly how to find this, you go to our channel, go to playlists, and then go down to advanced charting techniques. It's right there. Go to view full playlist. And here was our discussion of rate of change. Now, another thing you can do is just go to our channel and do a keyword search. So you can just do like rate change. And there's our rate of change discussion. But we used a trend confirmation during that discussion that's sometimes also employed by disparity index traders as a confirmation that even in the face of a strong extreme move that's recent against a short-term trend, maybe the longer-term trend is intact, and what we used was a combination of two exponential moving averages. We used the 50 and the 200, and the assumption for our trader here is as long as the 50 is still above the 200, maybe the trend hasn't completely broken down yet. So let's add that. Let's come up here. Now that we've had our discussion of how the disparity index uses the exponential moving average, the 13 exponential, I'm going to change that one. Let's change that one to a 50. And I'm going to make that red. And let's add another exponential moving average. And I'm going to change that one to a 200. I'll leave the 200 as green, kind of the cooler color. We'll change the shorter term one, the 50, to a red or a hotter color. But I also know that not everybody can tell the difference between green and red. You can't see it visually. So let's make the green one thicker. So the thicker line is going to be our longer term exponential. And then here's our shorter term exponential. And you can see, even with this comparatively extreme move to the downside, this is about the biggest move. Maybe one other was a little bit larger, where price got further away from our 13-period exponential moving average. This is the strongest short-term move to the downside in the entire year. But what about the overall trend? Our technician might think it's interesting. The 50 period, a shorter term trend line, still above a 200 period, might still be bullish. And this may, therefore, just represent a short-term pullback in an intact upward trend. And maybe that's the extreme short-term trade setup that our trader is looking for. So let's say that's going to be the case. And this is going to be our example trade for the day. But we need to talk about specific entries and specific exits. So the entry is twofold. First of all, we confirm trend. Is the trend up? And is price still at least above our 200 exponential moving average? It is quite common with the size of these pullbacks for price to cross down through the 50. That's not unusual. Matter of fact, in my experience, it's probably more usual than not. But with price still above an apparently upward trending scenario, that's trade setup signal number one. Number two is that we've dipped down far enough. I don't know what far enough is for our trader. It may be minus 7%, it might be minus 10%. How about for today's discussion, let's say that we want to see a dip of at least 10%. So in this case, we'd have about 3 qualifying events for this year. Interestingly, this one would not have qualified. This one does. Oops, I mean this one. Why not this one? Well, because that signal came while the stock was still in a downtrend. It worked out, but it probably wouldn't have been taken under this set of rules. Now, just being down at least 10% is sort of the setup. The trigger is when the disparity index turns up again. So now we're starting to narrow the gap between current price and the 13-period exponential moving average. So in other words, maybe the short-term momentum has tilted a little bit higher after being quite bearish. Zink says, if you have time, it'd be great to build a screener. Thank you for the transition. Let's do it. Let's go. We'll trade this one, but how did I find it? So here is how I did it. I actually built a custom screen. You can build it at home too on a live account. We can't do what are called study filters or technical filters on paper money. So I'm going to switch over here to an example live account. And Thea says, why don't we just use RSI versus the disparity index? So today I'm not making a case for which oscillator a trader might use if they're using any oscillator at all. There are definitely going to be similarities as we look at different oscillating indicators. RSI is an oscillator. MACD is an oscillator. Stochastic is an oscillator. Rate of change is an oscillator. Disparity index is an oscillator. So it's kind of like when you're at the gym and you got a whole bunch of different pieces of cardio equipment. Which one's the right one for that person that day? It's up to them. Yep. But probably the best plan of action is to pick one and get good at it, or get some practice with it, start sweating. So today we happen to be taking a viewer request to talk about the disparity index. So I will never try to make a qualitative case that one indicator is better than another. It's not my role. And I don't know my audience members on an individual basis sufficiently enough to say, oh, for your approach, this one would very likely be more productive than that one. I just explained these. So yeah, Journey actually, Journey asked the question. That's the 50, not 13 anymore. Yeah, I didn't mean to point at one. I was still talking conceptually and visualizing things in my head. You're exactly right, though. We still have the 50 and the 200 on our chart. But let's build a scan to find similar scenarios, because I would say at any given time, it might be 1 or 2% of stocks happen to have this configuration of technical indicators on a given day. So it's not terribly easy to find these things. So let's have a scan do it for us. So we're on our live platform. I've just hit the reset button to make sure that we're starting from square one on the scan tab. We're not going to use any of these stock filters, so I'm going to remove those. And instead, we're going to do 4 study filters. So I'm going to click on Add Filter. There's 1, 2, 3, 4. So our first filter is going to be making sure that the 50-period exponential is still above the 200. So we're going to come over here, click on the little Edit. Let's delete, and we're going to add a condition. And for this one, it's going to be that one study is above the other study. So our first study is going to be the exponential moving average that is 50 data points in length. And we want that to be greater than a second study, another exponential moving average that is 200 data points in length. And we want the 50 to be above 100 right now, today, within one price bar. So we'll just click Save. Moving average exponential 50 is greater than the moving average exponential ... that says 200. Okay, so we'll click OK, and we can see that is now the first requirement. Second requirement, let's make sure that price hasn't fallen below the 200. So let me click on the little Customize. Let's delete the ADX crossover and add our own condition. And this, we're going to have price. Let's just say today's opening price. Open, close is probably not going to make a ton of difference. But let's just say that we want the open under a price requirement is greater than our study, the exponential moving average, with a length of 200. There we go. And that is going to be our second requirement. So today's open price is greater than the 200 exponential moving average. Great. Let's click OK. Third requirement is that our disparity index is still down solidly below 0. So let's put that in. Delete the ADX crossover, add our study condition. And in this case, it's going to be our disparity index. We want that to be, let's say, is less than a value of, how about we say -7? All right. So I'm kind of throwing that out as a threshold. I want you to envision this. Here's our 0 line. The disparity index we're requiring to be down at least at -7. Now, why did I say -10? Because it's possible, maybe yesterday it was at -10 or -11, and it's just come back up to -7. I'm going to make a requirement that it's actually on the way back up. But in any case, not having already recovered so that price is not even below the 13 EMA anymore. So let's put in -7 here, at least still 7% below, price is still 7% below a 13-period exponential moving average is another way to explain that. So let's save that. So our disparity index is less than -7. Okay. Now finally, let's look for the little uptick, today's signal. All right, that's going to require that today's disparity index is higher than yesterday's disparity index value. We can do that. Let's click on the little customize icon. Let's delete the ADX crossover and add this condition. And if you're trying to follow along and, oh, Cameron, I messed up, I'm not doing this very well, I'll just share this with you. I'll just give you a link so you can just load it in if you want to. But let's go to our study requirement. We're still sticking with the disparity index. And in this case, we want the disparity index to be greater than the disparity index. So let's just load up the disparity index over here. But this offset means a number of days back. So I'm just going to put a 1 in here. So this is literally saying I want the disparity index to be greater than yesterday's disparity index. In other words, it's going up. And then we're just going to require that that's happening as of today within the last bar. And we'll click Save and then click OK. Now, if I set this up correctly, there's always a possibility I hit a wrong button. I don't think I did. Well, one other thing that I want to do, how about we just run this through the 500 companies comprising the S&P 500. So let's bring up Thinkorswim's public S&P 500 watch list. And we're going to search through that. And out of those 500-ish companies, let's see how many have a moving average of 50 that's above the 200, have the opening price still above the 200. The disparity index is less than -7, but on the rise. It's coming up from yesterday. There we are. Hey, what's right there? There's AMD. When I ran this scan just an hour ago, there were actually 5. So one of these things must have slipped. Maybe the disparity index is still climbing. It's got above -7. Maybe it's fallen below yesterday's. Maybe price has slipped below the 200. But in any case, we have 4 now. Should we just quickly look at the other 3? Commit to memory EL, EXPE, and CRL. Let's flash over here. Let's look at EL. Hey, yeah, look at this. We have a strong disparity index drop. We're starting to rise. We're still above the 200, and the 50 is still above that 200 as well. That could be an example entry. We have EXPE, very similar scenario, just reached relatively extreme lows, and we're still above the 200. And as I mentioned, look how many of these are below their 50. That's pretty common. And finally, what was the other one? CRL? My memory's not totally great. Yep. So let's go back here to our example trade and let's take this position. So we have our entry. Where do we plan exits? Well, this is looking for an extreme pullback. So that pullback is likely coming down from previous highs. A common exit is to just look to try to get back to those highs. So how about we have a plan to take profits if we can get back up here? Should we just call it 260? Shave off the tops there a little bit. And exits, well, this hook upward means that price is running back toward our 13-period exponential moving average. And so we should be, prices are stronger than yesterday's. We might just go below yesterday's low. So that looks like that was around 191. How about we just put in a stop at 190? Not going to be terribly patient with that. So there's our entry. We're going to take our trade, exit at 260, or our stop is going to be at 190. Let's go place our trade. All right. Now, last week's trade, we bought 50 shares at a price of about $118, about a $6,000 or $7,000 trade. Markets look a little bit stronger. Maybe our trader's a little bit more aggressive this week. Let's go a little bit larger. Let's go for a $10,000 trade. So with AMD, that would allow us again to buy about 50 shares. Pretty close. 50 shares at $200-ish per share. I'm going to right click here. Let's put in a custom buy order with an OCO bracket for, let's link these orders together, repair that broken chain link. So when I change the buy order to 50 shares, our sell orders change to minus 50. Let's put this in as a market order, just in the interest of a quick fill before we have to wrap the session up. But obviously market orders carry risk. Let's have our limit was up there at let me remind myself, 260. Make that a good till canceled order. And our stop down there at 190. Good till canceled. There we go. Let's click confirm and send. Buying 50 shares of AMD at the market price. Market price means we're not guaranteed the price that we're going to pay. We might have to pay even more than 207.59. We have a target up there at 260, trying to sell to take profits. If we stop, that stop will be triggered at 190. We're not guaranteed to sell at 190. It might be less than that, but we have that stop in place. There's no commission on this trade, but there can be on some types of trades, and we'll send that order off. There we go. Somebody just gave me the reminder. Hey, Cameron, can you remember to share the scan? Yes. Let me do that just quickly. Let's share the scan query. This is the disparity index scan. There we go. Let's click share, and I'll pop that over here in the chat. And as I do, I'll just throw out a quick reminder that shared links are not guaranteed as to timing or accuracy. I'm also going to add that to my video description. Go. All right, so I just made a mental note, or I added that to my session notes to put it in the video description for those that are watching on the archive after the fact. But guys, we've accomplished what we set out to do today. We wanted to talk through the disparity index. Thanks to the viewer who made the request. I think this was a very interesting discussion. Hope you enjoyed it. We talked about how it's built, how it might be used to plan and place trades. We constructed a scan and found some stocks that were giving apparent signals. Plan and place the trade. We'll see how that works out. But time for me to let you go. I want you to go enjoy your weekend. But as you do, remember the full slate of educational resources you have available to you from Schwab Education, including our Trader Talks channel on YouTube. If you haven't subscribed yet, just go down below the video, click on the subscribe button. It only takes a second. Doesn't cost anything, but this is where you can find the live streams. You can also find the archives from previously concluded webcasts. Now, I would also encourage you to follow your favorite Schwab presenters on social media. You can find me on X and on LinkedIn. On X, my handle there is @CameronMayCS. I'm very active here. I probably replied to about 30 comments today. So if you reply to one of my posts, I just try to reply right back to you as well. And I do the same thing on LinkedIn. So if you're following me on LinkedIn, or if you'd like to follow me, it's linkedin.com/in/CameronMayCS. And I just started on LinkedIn a couple of months ago, just a couple of hundred people following me there, about 18,000 on X, about 200 people following me on LinkedIn. But I'm posting regularly on LinkedIn. If you reply to my posts here, I reply right back to those comments. So everybody, enjoy your weekend. I had fun with this one. If you have more ideas for other topics for discussion on Friday, you can leave a comment. You can make a reply on my social media. I think next week I'm going to be talking about Dow theory. I saw Rachel Deshelle make a post on X about Dow theory. Asked my followers on X what they thought about that. They said, let's talk about it. So I think we'll talk about that. So I'll see you then. Everybody have a great weekend. Thanks for everybody for giving the thumbs up. That's always appreciated. That definitely helps. It gives my video a nice little boost on YouTube. But I will see you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.